All right, let's jump right in. We're going to unpack two of the biggest global shopping sprees in modern history. First, we have Japan's massive wave of overseas investment back in the 1980s, and then China's in the 2010s. Yeah, it's a story that probably sounds super familiar. A new economic superpower bursts onto the scene, its companies are armed with just mountains of cash, and they start buying up everything. Iconic skyscrapers, cutting-edge tech companies, you name it. First, it was Japan Inc., a name that, struck both awe and a little bit of fear into Western boardrooms. Then, about 30 years later, it was China's turn. Its go global policy unleashed an even bigger flood of capital onto the world stage. Now, on the surface, these two stories look like a perfect historical echo, a carbon copy. But here's the thing, they're not. The real story, the one that truly matters for understanding our world today, is actually in the differences, and that's exactly what we're going to break down. Okay, first up, let's just set the stage. Let's look at the sheer scale of these two investment waves. I mean, how big are we really talking here? Now, this is fascinating. While China's boom was way bigger in absolute dollars, we're talking hundreds of billions, Japan's was actually more intense when you compare it to the size of its economy back then. At its peak in 1989, Japan's overseas investment was 2.21% of its entire GDP. China's peak in 2016? A little lower, at 1.75%. It just goes to show you how explosive that moment was for Japan. So what lit the fuse for these massive spending sprees? Well, you might be surprised at just how similar the economic sparks really were. And right here, this is basically this secret recipe. For both countries, it was this really powerful 1-2 punch. First, a super strong currency. For Japan, the Plaza Accord in '85 made the yen incredibly valuable, which meant buying foreign stuff was a total bargain. For China, a strong and stable renminbi did the exact same thing. And second, a flood of cheap money. Japan had its bubble economy with crazy low interest rates, and China had a huge credit boom. Strong currency plus easy credit, well, that equals a global shopping spree. Okay, so this is where the stories completely diverge. The economic feel might have been the same, but the vehicles were heading in totally different directions. So the crucial point is who was doing the buying and why. Japan's wave was led by private corporate groups, the famous keiretsu, and they were just responding to market forces. They needed to build factories in the US and Europe to get around trade barriers. China's wave? Fundamentally different. It was dominated by state-owned enterprises, all guided by explicit government policies like Made in China 2025. Their goal wasn't just market share, it was to acquire strategic assets, technology, resources, key brands, all to fuel their national strategy. And you can see that difference in strategy perfectly reflected in where the money actually went. Japan's investment was laser-focused on its biggest markets, the US and Europe. China, on the other hand, cast a much, much wider net. Sure, it also invested heavily in the West, but a huge and growing slice of its capital flowed to countries in its Belt and Road Initiative, all across Asia, Africa, and Latin America, especially as those doors in the West started to close. And that brings us to maybe the single biggest difference between these two eras, the welcome party, or, the lack of one. Now, don't get me wrong, Japan's buying spree definitely made people nervous. There was backlash, a famous deal for a US tech firm got blocked, and that actually led directly to the creation of America's foreign investment screening body, CFIUS. But, and this is the key part, the scrutiny eventually faded. Japan was a close US ally, and its investments were seen as economic competition, not some fundamental threat to national security. The reaction to China has been on a whole different level. It wasn't just one country creating a new tool. It felt like the entire Western world was building a regulatory wall. The US massively expanded CFIUS. Germany tightened its rules after a key robotics company was bought. The EU created a bloc-wide framework. Today, dozens of countries have these powerful tools designed specifically to block strategic investments, because China is viewed not just as a competitor, but as a geopolitical rival. So what can we learn from the actual deals on the ground? Let's look at some iconic examples: the good, the bad, and the ugly. Let's start with the big, flashy trophy hunts. Both eras had one. In 1989, Mitsubishi bought the Rockefeller Center. I mean, the ultimate symbol of American capitalism. It was a move driven purely by prestige. Fast forward to 2014, and the Chinese insurer Anbang buys the legendary Waldorf Astoria for almost $2 billion. A deal just fueled by risky debt and some pretty unclear goals. And the results? Yeah. They were both pretty much a disaster. Mitsubishi bought at the absolute top of the market, so when the U.S. real estate market crashed, its holding company went bankrupt. The entire investment wiped out. For Enbong, the hit came from its own government. Beijing cracked down on what it called irrational investments, seized the company, and even jailed its chairman. Both trophy hunts ended in spectacular failure. But hey, it wasn't all doom and gloom. Let's look at two absolutely brilliant strategic plays. In 1988, Japanese tire maker Bridgestone bought America's Firestone. The goal was crystal clear: get a global network to compete with the big boys. Then, in 2010, the Chinese automaker Geely bought Volvo from Ford. Again, the logic was so clear: acquire world-class technology, safety engineering, and a premium brand. And just look at the results. The Bridgestone integration was tough, no doubt, but with patience and smart investment, it turned the company into a global leader. And Geely's approach with Volvo, it's literally a business school case study now. They had this hands-off model, giving Volvo capital but letting Volvo be Volvo. The result? Volvo is thriving, and Geely has used its technology to become a global automotive powerhouse, a masterclass. So, here's the bottom line, the big takeaway from all this. When deals are driven by a sound industrial strategy, a clear vision for creating real, long-term value, they have a real shot at success. When they're driven by ego, prestige, or risky financial games, they are almost always destined to fail. So, what are the big lessons here for today? First, geopolitical and regulatory risk is now, without a doubt, the #1 challenge in global investment. Second, for these strategic deals, that Geely-Volvo hands-off model seems to work best. Third, never forget about politics at home. China's crackdown on Anbang proves the home government can be just as big a risk factor. And finally, and this is the most important one, context is everything. China's story is not a simple rerun of Japan's. It's a whole new chapter with a very different set of rules. Which leaves us with a critical question for the future. In a world where every major investment is now viewed through a lens of national security and geopolitical rivalry, what does that mean for the flow of capital that connects our entire global economy? That's the new reality we all have to figure out.